Welcome to the fifth series of e-sessions on retail management. In the previous session, we had discussed the segmentation process for retail outlets. In this session, we would be discussing the growth and penetration strategies, the wheel of retailing, and the retail value. Talking about the retailer strategies, the three most prominent ones are your mass marketing strategies, concentrated marketing, and your differentiated marketing strategies. When we talk about mass marketing strategies, this is done for the customers or for the public on a whole, where you are trying to attract multiple segments. And because it is a huge public or it's a big customer group that we are addressing, it is generally you would be taking the assistance of technology, and you would need well-stocked stores. You would have express checkouts, lower prices, which would all focus on convenience for customers. Now, this does not focus on the efforts for any one particular type of customer or for any one particular segment of customers. This is mass marketing. When we talk about concentrated marketing strategies, here we are focusing on certain target segments. And based on that target segment requirement, these strategies are based. So it could be, there would be a high requirement of variety, deep assortment of selection in that particular category of products. For example, we could be able to distinguish for a working women apparel. Here there would be focus on all the different types of clothes a working woman would be wearing, and you would also have different styles, different designs, different brands, all under one roof. So you're concentrating your efforts on a target segment group, that is the working women and their apparels. When we talk about differentiated marketing strategies, here we are talking about stores which are catering to different segments, and it could be possible that two or more distinct segments are taken into consideration. When we talk about men's apparel, then there are two distinct categories there, that you would have one segment for men in general and one for boys. So these are two distinct categories, and therefore the strategies which would go for these two distinct strategies would also be different, and hence called as differentiated marketing strategies. Now, once the target segments are identified, that is when a target marketing strategy is designed. So first, whenever a target market has been identified, at that point you decide which specific target market you would like to sell your wares or your products to. And then from the target market, you would be able to understand what are the characteristics, what are the needs that this target segment would require, what is their attitudes, their perception, and what is their buying behavior. And from there onwards, you would be able to decide like what sort of product strategies should be there, what should be the target market strategies, what should be the prices, and this way, you would be finally able to design a target market strategy. Now, to understand the growth and penetration strategy, we are taking the help of an Ansoff matrix, because this talks about the growth and penetration. So the two axes that we are considering is your existing products and your existing markets, or your new products and your new markets. So based on that, four different segments have been formed. That is your market penetration, product development, market development, and diversification. Let us try to understand each segment, how the strategies are varying from these segments. When we look at the market penetration strategies, this is gaining a market share in the existing market with the existing customers. So the effort is there to be able to increase your market share in the existing market itself. So you are increasing the sales volume for the existing customers. So in other words, you could say that you are increasing your basket size. You might also increase your market share by increasing the frequency of usage. It could be the amount of products which is being used. So that is the size that they are purchasing, that is being increased. It could also be an identification of different applications and usage of the existing products. So these would be accounting to your market penetration strategies, where you are trying to increase your market share in the existing market with the existing customers. Now, when we look at these penetration strategies, what do people or what do marketers do to increase penetration? First effort is to increase advertising so that you are able to attract new customers. Second strategy would be to lower the prices. That could come in the form of discounts or offers. And it could, the other point would be that the distribution of these products can be increased. So there should be a high distribution like you would have with products like Coca-Cola. Now, all the Unilever products, they are following market penetration. The growth strategies. Here, market development, product development, and diversification. All these three segments are taken under your growth strategies. What is market development? This is when a company focuses on selling the existing products or services to new markets or new segments. This focuses on developing a new customer base. The second growth strategy is product development. Here, the focus is that the company works on innovation in the existing products, or they are developing new products for the existing market. So here the effort is to increase your customer base by bringing in new customers, new market segments with the existing formats. So these are being increased. Now the third growth strategy would be your diversification. Here the company works on developing new products or services for new markets. So new retail formats could be selected or new market segments could be identified. Now, when you see this as a picture, the penetration strategy is about creating a strategy. That is the area when the strategy gets implemented. These strategies, when implemented, it comes into the growth cycle. And after the growth cycle, you have gained a sustainable market share. But slowly, the product's sales start declining. And that is when the risk for the product starts, and it might slowly enter into the diversification phases if not taken care of. Now let us discuss the next point, that is your retail value chain. So our value chain is a step-by-step business model which is used for transforming a product or service from an idea to a reality. This value chain, this helps the businessmen increase the efficiency of a business so that they can deliver more value at a very minimal cost. So this is ultimately about the cost and the price that is being given to the customer. This focuses on a problem-solving approach, and this provides useful services that meet the customer requirement. Marketers or retailers, they spend significant time and effort in shaping the customer's experience. They focus on how a store layout should be made, how should a website be designed, so that the customer finds it very convenient to navigate through these stores and locate whatever product they want to buy. This is also about finding opportunities to increase the share of sales and the overall order sizes. So the efforts that are seen, which has been put towards, is increasing point of sale, upselling, cross-selling. These are the focuses of your retail value chain. You can see the diagram here of a value chain analysis, where it is divided into key activities, that is your primary activities, and your secondary activities. So here the focus is on warehouse management. It could be on sales operations. It could be on the sales strategies that you wish to design. This could be on trying to achieve a positive or a right merchandise mix. So all these together are able to create a very good value chain. Moving on to the third topic, that is wheel of retailing. Here it can be very clearly seen that the wheel is divided into four major portions in which a product is passing through, the life cycles through which it is passing. This theory was proposed by Malcolm and McNair. This is the structural changes theory in retail. Now this theory is about the cyclical and the circular development. It explains how retail institutions transform during their revolutionary life cycles. So the four principles of wheel of retailing is that there are many price sensitive customers or shoppers. So these price sensitive shoppers, they often are very not so loyal, and they switch to retailers with lower prices. So there are new institutions which are able to cater to these low operating costs, and hence they come out with products at a lower price. As they move up the wheel, they try to increase the sales and broaden their target market and improve the image. The wheel of retailing, this is a very, very dynamic industry. So new firms, whenever they introduce innovative products, so this approaches into the first phase where the price is less, there is low status, low margins, and hence at lower price the products are made available to the customers. The market size is also very low because this is a new a segment in which the market has entered. Now, when you look at the development is still at the entry stage, and therefore we are calling it as the development or the introduction stage. The next stage, this is the growth stage, or we could also call it as the trading up stage. So this is followed by maturity, and then we find that the product goes into the decline stage. So the stores which cannot compete, they pass into that decline stage. Now, when we look at this diagram again, we can see that in the growth phase, the prices have gone up, the margins have gone up because now the operating costs are higher, there are more people who are buying, there is more awareness about the product, and therefore your price, status, and your margins, all the three go at a higher variation or at a higher level. Then it is followed by the third stage, which is the maturity. Here you are earning very high price, earning higher status, and even higher margins. But slowly, because now you have reached at a very high price stage, there could be a possibility that a new company might come in, and because its operating costs are less, the price would be lower. We know that the customers are not so brand loyal, or they are not so loyal to a particular product or service, and they might immediately switch to this new possibility or the new product which has been launched. And hence, maturity to the decline stage is the vulnerability stage. So the references which have been used for the preparation of this session are as given below. Thank you.